Okay, good afternoon, students. Welcome to our review and discussion this afternoon. So this will be the coverage of your exams this lesson and will be another lesson that I will introduce to you later on. So the first lesson is the sources and uses of short-term and long-term funds. So we already discussed about this one. You can rewatch the video that is being uploaded in YouTube. So we have here debt financing versus equity financing. So when we say debt financing, it is through borrowing, whether short term or long term. So there is debt financing is usually comes with interest, and there exists a borrower-lender relationship. So in the case of banks and other non-bank institutions, borrowing entails compliance of certain requirements. Of course, kung mangutang ka sa bangko na magiging mga requirements, right? So, muna siyang inyong timanan sa debt financing. It is done through borrowing. Nag-borrow ka og money, whether short-term or long-term. So, when we say short-term, it is more on payable siya within 1 year. Mulapas nagali siya in 1 year, that is now called long-term. Okay, and it comes with interest. Kung mingon kag debt financing, usually comes with interest. And naa siya, there exists a borrower-lender relationship. Now, when we say equity financing, on the other hand, class, this refers to sale of ownership interest. So, for example, stock shares, raise fund for business purposes. So there are dividends and profit shares that has been declared, set aside and paid by the business. So that is equity financing. So this is very common in corporation. Corporation nga mga type of business. So when we say debt financing, there exists a borrower-lender relationship. While in equity financing, what does exist in this kind of financing? We have the investee-investor relationship. So again, short-term, when we say short-term financing, in that you will be able to schedule to pay within 1 year, while ang long-term financing is, ang imong utang is paid more than 1 year. So next is, what are the sources of funds? When we say sources of funds, we have three. We have banks, the credit cooperatives, and we have commercial finance companies. So when we say bank, we already know that banks, mga bangko, so it is supervised and regulated by Bangko Sentral ng Pilipinas. So this is a establishment where you deposit, custody, and issue money for making loans and discounts for making easier the exchange of funds. So we have commercial banks, thrift banks, and rural banks, cooperative banks. So that is an example of bank. So that is one of the sources of funds. We have banks. So when we say, again, when we say bank, it is supervised and regulated by Bangko Sentral ng Pilipinas. This is where you deposit your money, you give the custody to the bank for your money, and also the bank will issue the money for making loans and discounts. So examples of banks include universal and commercial banks. We have thrift and rural and cooperative banks. Then second is, we have credit cooperatives. When we say credit cooperatives, the quality of life of its members is the primary objective of the credit cooperative. So for example, we have Life Bank, mga cooperatives. There are like microfinance na mga cooperative, and also all the cooperatives are regulated and supervised by the Cooperative Development Authority, or the CDA, and the Bangko Sentral ng Pilipinas, in coordination with the CDA, they shall prescribe the appropriate prudential rules and regulations applicable to the financial service cooperatives. Then lastly, we have commercial finance companies. So when we say commercial finance companies, they are organizations without a bank charter that advances funds to business by discounting notes receivable, making loans secured by mortgage. So when we say mortgage, this is kung mag-loan ka unsa imong qualateral. Okay, so that's it. So unsa man ang imong assurance nga unsa may assurance sa bangko para nga makabayad ka. So you are going to give the lot title, ang imong motor, imong ref, imong TV baka ha if dili ka makabayad sa imong utang, then that is those item nga imong mortgage or imong collateral mo to siya ang kwaon sa bangko. So that's it. That we have three sources of funds. We have the bank, credit cooperatives, and we have commercial finance companies. So there are usual loan requirements. So what could be the usual loan requirements and application if ever nga maka-decide mo nga mag-loan? So first is the demographic. So when we say demographic, this include name or business name, the birthday, address, SSS number, TIN number, phone number, and other identifying information such as valid government issued identification card. So when it comes to loan application process, the receipt of application form and required documents. So second is the income or revenue. So of course, if mangutang ka, ako ang magpautang, I should really take a look with your income or revenue. Why? For me to know if makabayad-bayad ka sa imong utang. So this refers to the current, so income and revenue, this refers to the current personal income and employer. So employment and salary history and business revenue if there is already an existing business. So assets and liabilities. When we say assets and liabilities, the applicants may ask to disclose their checking, savings, and investment accounts and their outstanding loans and credit cards if there are any. Then we have contact or references. So this contact or references, of course, the creditor would really make sure that the person na iya ang gipautang is a good payer, makabayad gyud siya. So they have to ask for your background. So this requires identification and contact information of existing employers, previous employers, and also even nearest relative not living with the identified contact. So lastly is attest and authorization require affixing applicant's signature on the credit application. So stating that everything on the application is true and correct, and authorizing the lender to verify the information provided with identified contacts and references. So the credit department evaluates on the basis of the character, the capacity, the collateral, capital, and conditions, or the 5 C's. So make sure to memorize all of those things because it will make sure come up in your exam. So we have the 5C again. The 5C are the character, capacity, collateral dito siya, and capital and conditions of the credit. Okay, so that is our first lesson, part of the coverage of the exam. Now next, I am going to show to you our next topic, which is how are we going to compute interest. We are going to talk about the simple and compound interest, okay? Okay, so we are going to talk about interest. Might be in your exam that you're going to fill in the box where you're going to identify how much is the interest in the simple interest and how much is this interest in the compound interest. So that's it. So interest class is the excess of resources, as you can see in the screen. And interest is usually on cash. So it is received or paid over the amount of resources loaned or borrowed, which is called the principal. Let's just say, for example, I have 10,000 and I have the interest is 10%. So I have 1,000 per month as the interest. So how much is my principal amount? That will be 10,000. And then the interest is 1,000 pesos per month. So if you decided to invest your money class in a bank, you will ask the banker how much interest you will get. So the banker will then explain that there are two types of interest that will be used to determine the amount of interest that are going to receive. So remember that interest is beneficial for you when you are receiving it, but not when you are paying it, right? Why? Because lisod yun kayo magbayad of loan, which is na interest. Lisod yun kayo. And that's why it's beneficial for you when you are receiving it, then you are paying it. So it is important to know which type of interest when deciding where to put your money and where to get your money. So now we are going to talk about the simple interest. When we say simple interest class, it is the product of the principal amount multiplied by the period's interest rate. So usually an interest rate is a 1-year rate in standard. So let's take, for example, this example one. You invested 10,000 for 3 years. So at 9%, the proceeds from the investment will be collected at the end of the 3 years. So using the simple interest assumption, the calculation will be as follows. Okay, so now we have year 1, 2, 3. It states here that 3 years. You invested 10,000 for 3 years. So year 1, 10,000, padulong na siya sa 3 years, 10,000 ra yung invest. So it says here that simple interest is the product, which is you multiply the principal amount by the period's interest rate. So interest here is, we have 9%. So we just simply multiply 10,000, the principal amount, times the period's interest rate, which is 9%. So the 9% of 10,000 is 900 pesos. Same process from year 1, year 2, and year 3. And then we have cumulative interest. When we say cumulative interest, gaanam siya og dugang. So 900 for year 1, we have 900 plus 900, which is the interest for the year 2. We already have 1,800 plus 900 pa yun because of the interest for the year 3. Then we have 2,700. So a total of 12,700. Why is it na 12,700 man na siya? Because 10,000 plus 900 is equal to 10,900 plus 900, that will serve us 11,800, or much better if you're going to add 10,000 plus 1,800, that will be 11,800. So in the third year, we have 10,000 plus 2,700, which is the cumulative interest. Now we have the sum of 12,700. So see, the principal amount which is invested from year 1 to 3 of 10,000, pila ang dako or pila ang gibutang ang ni tubo sa money ng 10,000, they have 2,700. So that is simple interest. You just simply multiply the principal amount by the period interest rate. Now we have compound interest. When we say compound interest, it is the interest paid on both the principal and the amount of the interest accumulated in prior periods. So when we say accumulation, is that ang interest ani is mag-interest na pud na siya. Okay, so using example 2, using our example 1 in the simple interest where you invested 10,000 for 3 years at 9%, as the proceeds from the investment will be collected at the end of third year, compound interest will be computed as follows. So this is how are you going to compute the compound interest. Okay, so we're back. So yeah, using example 1 still, where you invested 10,000 for 3 years at 9%, and the proceeds from the investment will be collected at the end of 3 years. Compound interest will be computed as follows. So still, we have year 1, year 2, and year 3. The principal in year 1 is 10,000. Unlike in the simple interest, 10,000 na na siya tanan. Okay, but here is different. So in year 1, we have 10,000, the interest still 9%. So we have 10,000 times 9% is 900 pesos. So in year 1, the cumulative interest is 900. So wala pa man tayo ma-add. So if you are going to add the interest plus the principal, we have 10,900. So this 10,900 will be the beginning investment or the beginning capital in the year 2. That's why this 10,900 is na siya sa principal amount in year 2. So 10,900 times 9%, that will equal to 981. So the cumulative interest for that one is 900 in year 1. The 900 interest in year 1 will be added to the 981 interest in year 2. That's why we come up with this 1,881. So this is the cumulative interest. So we are going to add this 1,881 plus 10,000 pesos. So this 10,000 pesos that will equal to 11,881. Sure nga nang dili man siya 1,881 plus 10,9. Why? Because 10,9 is already added sa 1,881. So ang 981 plus 900 muna siyang 1,881. So we are going to add this and the principal of 10,000. That's why 11,881. Dili na to siya pwede nga si 1,881 i-add na to siya kang 10,9. Why? Because si 900 naa naman siya apil diri kang 1,881. Okay? Unless you're going to add these two, 10,9 plus 981, that will result to 11,881. Then on the third year, our beginning investment will be 11,881, which is the result of the cumulative interest in year 2. So times 9%, which is the interest rate, we come up with 1,069.29 pesos. So 1881 plus 1,069.29, then we have 2,950.29 plus 10,000, the principal amount, then we come up with 12,950.29. So that is our compound interest. So the compound interest formula, as you can see here, we have FB is equal to P, which is the principal, times 1. 1 is constant, nanagin na siya permanente, dili na siya pwede mawala, plus I, which stands for the interest rate per compound interest period or periodic rate, close parenthesis, and N. This small letter N stands for the time period of number of compound interest period. Okay, so subtract the principal from the future value to get the compound interest. Hence, interest in compound is the future value minus principal. So might be that I will be asking you, find the compound interest of this amount. So your formula will be I is equal to FV minus the principal, the future value minus the principal. So future value of money. So to account for time value for single lump sum payment, we use this same formula provided for under compound interest rates, as shown in the illustration above. So where PV is equal to present value. So here in your compound interest, we have FB, or the future value, is equal to principal times 1 plus interest rate over the time period or number of compound interest periods. But here in our future value of money, we are going to compute using the formula of future value is equal to the present value plus 1. Again, 1 is standard, nagnan gina siya permanente, plus interest, and then N, again, it stands for that time period or number of compound interest periods. So the future value is the value of the present value after N time period. So using the formula, we are going to find the future values of 1,000 pesos compounded at 10% annual interest at the end of 1 year, 2 years, and 5 years. So our solution is this. Present value na to. We are going to look for the future value of 1,000 pesos. So our present value is equal to 1,000. And our interest rate is 10%. So in year 1, we are just going to simply follow the formula, which is FB is equal to PV plus times 1 plus I and times. So in year 1, we have here 1,000, 1,100. Then we have here 1,210 and 1,610.50. So again, I forgot your schedule, but during the exam on my subject business finance, kindly bring scientific calculator. I will not allow you to use your phone. Okay? Wala gyud po'y pulos ang inyong phone. You really need scientific calculator. Okay? Then in example number 4, we have here determine the compound amount on an investment at the end of 2 years if present value is if 20,000 is deposited at 4% compounded as semi-annually and quarterly. So here we are going to look for the amount on investment at the end of year 2. So given that we have the present value of 20,000, our interest is 4% compounded semi-annually and quarterly. So we have 0.04 over 2. Sure, why is it nga naman siya over 2? Because this is semi-annually. Diba, our interest, ang standard niya is yearly. But then, when we say semi-annually, it is 6 months. So, duha ka 6 months in 1 year. That's why we have over 2. And our n is equal to 2 times 2 is equal to 4. Sure, why is it that our n is 4? Ngano man tuod na siya? Why? Because compounded semi-annually and quarterly. It is quarterly. So we have 4 quarters in 1. I know. Wait lang. This is 4 because semi-annually, compounded semi-annually. So 2 years manggod siya. So in 1 year, we have 2 semi-annually and another year 2 semi-annually. So that's why 2 times 2, we have 4 semi-annually. So we have the future value here is equal to 20,000 plus 0.04 over 2, then raised to the power of 4. Then we have 21,648. So this means that the future value of 20,000 that is deposited at 4% compounded semi-annually will be 21,648. Letter B, we have here quarterly. So when we say quarterly, we have our given 20,000 still. Then we have 0.04 divided by 4. Sure, why is it that it's 4? It's not 2. Because quarterly ang nakabutang. When we say quarterly, that is January to March, April to June, July to September, October to December. So we have 4 quarters in 1 year. So here we have in our time period, we have 4 quarters times 2. Why? Because this is 2 years. Okay, kani sila is 2 years na siya. That's why we have times 2 is equal to 8. So our future value of 20,000 that is being deposited at 4% compounded quarterly will be 21,658. Okay. Okay, so we have here and last in our discussion for this afternoon will be the present value of money. So in our future value, we identified what will be the future money, pilang mabot sa money if it's in 3 years or 5 years being deposited at that kind of time period and interest rate. Now we are going to discuss about the present value of money. So to get the present value of a lump sum amount, we arrange on this equation. The formula is PV, or the present value, is equal to future value times 1 plus I minus raised to the power of negative n. So where 1 plus I negative n is equal to the present value interest factor or discount factor. So in our example 5, we have here Jack would like to buy a car 2 years from now using the proceeds of a 20% investment that is compounded semi-annually. So when we say semi-annually, this is every 6 months. So if the projected price of the car is 1,400,000, how much money must be invested today to earn the price of the car? Okay, so given that our future value is 1,400, then our interest is 20% and semi-annually, so this is divided by 2. Our time period is 2 times 2 years is equal to 4. Why is it not 2? Asa man niya nakuha ng 2? because it says here that Jack would like to buy a car for 2 years from now. So that's why we have 2 years. So semi-annually, so we have here 2 times 2 years is equal to 4. So our present value is 1,4 plus times 1 plus 0.20 over 2, then mine raised to the power of -4. So our amount is 956,200. Okay, so this money, 956,200, this money should be invested today to earn the price of the car for in 2 years. Okay, so that's it. So this will be the coverage of our exam next week, and I will not allow you to use your cell phone. Kindly look for a scientific calculator because dili yun siya pwede ang phone. Okay, so I hope you understand and study in advance. Make sure to memorize all the formula because I will not allow you to have a piece of paper written the formula there. Okay, there will be no such thing like that. Okay, so I hope I am clear. So thank you everyone and God bless.